Welcome to today's presentation. Today we are going to discuss how to avoid paying taxes on an inherited annuity. Brought to you by JenniferLangFinancialServices.com. Inheriting an annuity can provide an unexpected financial windfall, but there are certain tax implications to consider. Whether you'll owe taxes, how much and when you're required to pay them, depends on how the annuity is structured and how you choose to receive benefits. Here's what you need to know about inheriting an annuity and minimizing taxes that come with it. So what is an inherited annuity? Well, when someone purchases an annuity contract, they may have the option to name one or more beneficiaries. Those beneficiaries are then eligible to receive payments from the annuity if the original annuitant passes away. There are a few reasons why someone might choose to name an annuity beneficiary. First, if a beneficiary is not named or if it's not a joint and survivor annuity, which would continue paying benefits to a surviving spouse, any remaining money in the annuity would be lost. The financial institution the annuitant purchased the annuity from would get to keep any remaining benefits. Second, naming beneficiaries to an annuity is one way to create a financial legacy for loved ones. If you have adult children, for example, you may want to name them as beneficiaries to a joint and survivor annuity so that they can receive any remaining benefits once you and your spouse die. An annuity can be used to supplement other financial resources, such as life insurance or a trust, inside of an estate plan. Some annuities can't be inherited. If you purchase a single life or life-only annuity, for example, the annuity would only pay benefits to you during your lifetime. There would be no death benefit to pass on to a beneficiary. Understanding how inherited annuities are taxed starts with knowing the difference between qualified and non-qualified annuities. A qualified annuity is an annuity that's purchased using pre-tax dollars through a tax-advantaged account, such as a 401k plan or an individual retirement account. Any distributions paid to the annuitant from a qualified annuity are treated as taxable income in the year they're received. Withdrawals made before age 59 and a half are subject to a 10% early withdrawal penalty. Qualified annuities must also follow the required minimum distribution rules. A non-qualified annuity, on the other hand, is funded using after-tax dollars. That kind of sounds like a Roth account, but there's a catch. The contributions made to a non-qualified annuity aren't taxable, but any growth or earnings on your initial investment are tax-deferred. In other words, you have to pay ordinary income tax on the earnings part of your distributions. But there is no 10% early withdrawal penalty to worry about, and you don't have to deal with our MDs either. How to avoid paying taxes on an inherited annuity is usually dictated by your status as a beneficiary and how you decide to receive payouts from the annuity. If you're the spouse of the original annuitant, then you can choose to continue receive payments according to the annuity schedule. In that instance, any taxes owed on distributions would be deferred until you receive them. The rules work differently, however, if you inherit an annuity and you aren't the annuitant's spouse. When you have to pay taxes depends on how you decide to receive distributions from the annuity. There are 4 ways to take money from an inherited annuity. Number 1. A lump sum. You could opt to take any money remaining in an inherited annuity in one lump sum. You'd have to pay any taxes due on the benefits at the time you receive them. Number 2 involves the 5-year rule. The 5-year rule lets you spread out payments from an inherited annuity over 5 years, paying taxes on distributions as you go. The only caveat is that the entire annuity benefit has to be distributed by the 5th year. Number 3 is the non-qualified stretch. You take the remainder of the contract and stretch annuity payments out over the rest of your life. Your life expectancy sets the basis for your actual payment amount and schedule. Number 4 is the periodic or annuitized method. With this option, you get payments for the remainder of your life, but the payment amount is not based on your life expectancy. Out of these 4 options, choosing the non-qualified stretch or periodic payment options would allow you to spread out tax liability for inherited annuity payments. But you'll be waiting longer to receive all of the remaining money in the annuity. Choosing the lump sum route or following the 5-year rule would put the money in your hands faster, but you'd take a bigger tax hit in the short term. Unfortunately, you can't completely avoid paying taxes when you inherit an annuity. But there are things you can do to defer payment on what you inherit. For example, exercising your option to continue receiving payments as usual if you're a surviving spouse is one way to maintain the tax-deferred status of an inherited annuity. Similarly, you can lower your tax exposure by opting for non-qualified stretch payments based on your life expectancy or periodic payments if you're inheriting an annuity as a non-spouse. There are a couple of other methods you can try that require more advanced tax planning. For example, you may consider a 1035 exchange, in which you exchange the annuity you inherit for another annuity. The catch is that the exchange has to be similar in nature. In other words, you can't exchange a qualified for a non-qualified annuity or vice versa to try and escape taxation. The main reason for considering a 1035 exchange of an inherited annuity would be to switch to an annuity with more favorable terms or benefits. Another option is rolling an inherited annuity into an IRA. However, this is only an option if you also inherited the deceased annuitant's IRA. If you inherit your father's annuity, for example, but he didn't have an IRA or he named your sibling as beneficiary, you wouldn't be able to roll the annuity over to a personal IRA in your name. Assuming you're able to roll an inherited annuity over, you'd then be subject to inherited IRA tax rules. While you can't avoid paying taxes on an inherited annuity, there are things you can do to minimize them. If you know you'll be inheriting an annuity or if you own an annuity that you plan to leave to someone else, it's helpful to understand the potential tax implications beforehand. While inheriting an annuity can provide a financial benefit, it can also result in tax headaches if you're unprepared. Here are a few tips. If you're on the receiving end of an inherited annuity, consider talking to a financial advisor about how to manage your tax liability. If you're considering purchasing an annuity, learn how different annuity options work. Ask if you can name a beneficiary and how payments will continue if you're buying a joint and survivor annuity. Also, research the various costs involved in purchasing and owning an annuity. At JenniferLangFinancialServices.com, we can do the shopping for you. We work with over 25 of the best A-rated carriers to find you the rate to fit your age, time horizon and goals. Visit us online today at JenniferLangFinancialServices.com and request a free annuity quote and consultation. Thank you for attending. Stay safe.